Adobe, ticker symbol ADBE, just reported its earnings, and it has been a volatile session in the after hours. The stock being up about 4% at the highs, down about 1.2% at the moment. And we're going to talk about why. Why was the stock so volatile? We're going to talk about the earnings, the good, the bad, the ugly. And we're going to ask and answer the question, is Adobe a buy right now? But before we do that, if you could please go ahead, like and subscribe. It really, really helps me out. Let's dive in. So I'm sure all of you know what Adobe do. They have a suite of apps dedicated for creative purposes, whether it's video editing, illustration, Photoshop, photo editing, the whole 9 yards, document creation. When it comes to doing anything creatively, Adobe probably has an app for it. And they charge a subscription fee for this on a monthly basis. And you can subscribe to one, some, or all of these applications at once. And generally speaking, Adobe's products are top of the top. They're world-class products. The best of the best professionals are using Adobe's products to create movies, image posters, advertisements, and everything in between. Now, Adobe's earnings were actually very good. We saw a double beat. They beat on revenue, beat on EPS, growing revenue about 10%, reporting about $5.87 billion. EPS of about $5 per share. That was 13% growth. So the business seeing quite a bit of operating leverage. You tend to see that when you have a figure of revenue growth and then the EPS grows a little bit more. That means the operating expenses didn't grow as much as revenue. That's a good thing. Looking at the quarter in aggregate, we saw gross margins tick up ever so slightly, but whenever gross margins increase, that's really, really good. And generally speaking, based on Adobe's business model, you're always going to see gross margins tick up every single quarter incrementally. It's just the nature of a software business. Net income did fall, at least the net income margin, from 29.6 to 28.7. However, nominal dollars increased because revenue increased 10% on a year-over-year basis, and net income grew from 1.57 to $1.7 billion. Free cash flow margin did increase. Very, very solid stuff here, from 35 to 36.5%. This is such a profitable business, and the company saw $2.1 billion in free cash flow for the quarter. Insanely profitable business. Now, Adobe reports in two segments. They have the digital media segment, which did about $4.35 billion in revenue, grew 11% year over year, 12% at constant currency. And you're looking at about $18 billion in annual ARR just from their digital media segment. Then they have their digital experiences segment right here. This is a fairly newer segment. Their smaller segment, it's growing at about 10%, and you have about $1.3 billion in annual recurring revenue or subscription revenue Now, total revenue came in at $5.873 billion. That grew 10.6% to be exact. The cost of revenue increased 6.6%, and that's that operating leverage we were definitely talking about. You could see here that operating expenses also grew 10.6%. Very solid stuff. And then operating income grew 11.8%. And with all of the share buybacks they did, earnings per share grew 13%. And then Adobe actually reported their guidance right here, their financial targets. In fact, this was a raise against the consensus, although it was ever so slight. In fact, you would probably call it in line. It was such a slight raise. For example, GAAP EPS here was $4 to $4.05, right? The consensus expectation was for about $3.98 at the midpoint. So, a slight raise ever so slightly. And the company's still looking anywhere from about 10 to 12% growth on the quarter, on the year as well. Very, very solid stuff. So essentially what Adobe did was a double beat and raise. Very good stuff. And when you look at their remaining performance obligations, they have $19.7 billion left for the full year. It's essentially revenue from their subscriptions. And when you take this figure right here and what they reported in the first quarter, you can then probably come to a rough estimate of what their revenue can look like. Let's say if it was to materialize right now, not including additional growth they see in the underlying customer count. So very solid stuff right there. Very predictable business. Based on the RPO performance, you probably have a good gauge as to what Adobe is going to do with their revenue in the future. Now, Adobe also repurchasing a bunch of shares. They repurchased 8.6 million shares during the quarter. And in recent quarters, this has ramped up, but this has been a general trend from about 2020. And that's because the stock hasn't really gone anywhere, and the company really just piling a whole bunch of money into buybacks. You can see in the past 5 years, the stock is only up about 1%, but they're buying back a ton of shares. You can see it in the trailing 12 months, they bought back 3.79% worth of shares. In 2023, they were buying back a ton of shares. Even in 2022, 2021, they were still buying back about 1% of the float every 12 months. And, if a stock is not going to do anything and you have a company with like 40% free cash flow margins, you may as well just buy back as much stock as you possibly can. But the reason why the stock hasn't really done anything in 5 years has to do with a whole bunch of stuff. The first one is AI. There is this risk that AI is going to come in and disrupt Adobe's business in aggregate with image generation, etc. And that's a valid concern. The other concern is actually growing competition. Stuff like Canva, right? These are very easy to use platforms, cheaper to use platforms, and their functionality is almost as good as Adobe's, where you'll be paying hundreds of dollars. You can just get a Canva subscription for like $10 per month. And then also this right here, Figma. Adobe, because of its size, has been limited in the acquisitions it can do. Their Figma acquisition got shut down by Lina Khan, and I hope they've had a lot of other legal troubles as it pertains to the rights of their creatives, etc. And that is going to weigh on the stock in aggregate. So all of this has meant that the stock has been very volatile. We've seen strong moves to the upside, strong moves to the downside, right? But in aggregate, the stock really just flat for the last 5 years. And in a situation like that, you buy back stock. But in those 5 years, the valuation is actually very reasonable. The stock right now trades at a 14.5 times EV to EBITDA next 12 months, 19 times price to earnings. Just for the record, the S&P 500 trades at 22 times forward. So to actually see this below the market multiple, you would say that Adobe is looking very attractive. The company has a shareholder yield of nearly 5%, just shy of 5%. And when we plug all of these figures into our valuation framework, right, we're going to assume 8% growth sequentially, which is slightly below market's expectations. And then we're going to see free cash flow margins go from 40% to 45%. I don't think that's absolutely crazy because there's multiple quarters where Adobe currently reports 45% in free cash flow margin. So 45% is not crazy. The current free cash flow margin on the trailing 12 months is a smidge under 40%. So I don't think 45% is crazy. The consensus growth is for about 10%, so we're coming in slightly below consensus. And so we're looking for $33 billion in revenue in 2029. That would equate to just under $15 billion in free cash flow. If we use an 18 times EV to free cash flow multiple, right, we subtract the net debt and divide by shares outstanding, which is decreasing 3% every single year, you're looking at a business that could be valued at about $732 in 2029. The current share price is about $413. And you're looking at about a 12% projected annual return. Very solid stuff. Fair value right now is $415. So look, buying Adobe right now, you'd be buying the stock at fair value when discounted at a 12% rate. So, definitely Adobe looking very, very attractive, but you would need to go ahead and assess the destruction risk from AI, competition, etc. But look, in the year and now, when you look at their financials, the company is growing, they're building operating leverage, they're buying back a ton of shares. If AI is going to disrupt the business, we're not seeing it right now, but the market is always pricing ahead in the future. Now, looking at the technical charts, Adobe is still below the 200-day right here. I think these earnings should probably get it above this 200-day right here. I think these were actually pretty good earnings. If you ask me, they're going to continue to decrease their float and buy back shares and just execute on their organic revenue growth. I don't think they're looking to do any acquisitions, especially after the Figma drama. And I think they're just going to compete with AI by, building it in-house. I think this is probably a great place to get into Adobe here at the 400 region and potentially targeting, some of these higher levels, 500, 550, maybe even the $605 area. And, if you are a bull and let's say this valuation framework we have here does play out at the 700 level, you're looking at potentially all-time highs. And that would represent close to 70 to 80% upside from where we are right now. And that's not bad, all things considered, especially with where valuations are for companies that have a 40% free cash flow margin. But again, take this with a grain of salt because it is dependent on those margins expanding. If we assume a 40% free cash flow margin, you're probably looking at a projected return over 5 years of about 5%. So is Adobe a buy right now? I would say yes, based on this, but for me, am I a buyer? I am not, just because I need to do more research into the competition. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.